Hi, I'm Professor Larry Louie, and welcome to Financial Acumen. So today we're going to start with an overview of the finance industry. So I entitled this topic The World of Finance, and it's broken into 3 lessons. First is an overview of the financial institutions and markets. Second is looking at the governance, oversight, and regulation that we find in the finance industry. And finally, do our systems have integrity? And this I entitled as The Good, the Bad, and the Ugly. This is one packed slide, isn't it? But it looks at the people that have money, and these are people on the left, people that need money or want money, those are people on the right, and all the things in the middle, called the markets and institutions, that facilitate the movement of capital from those who have it to those who need it. And this is what we have as far as the different players that we'll be working with throughout our studies of financial markets and companies in general. So on the left, we have those with funds, and they can put money in many different things. If they want something relatively safe, they could invest in a bank and get fairly small amounts of savings, interest, or CDs, certificates of deposit. Or they could put money in the money market funds, which are slightly higher interest yielding than banks, but they don't have the exact amount of insurance coverage that banks do. So a little bit more risk for a little bit more return, but generally they're considered safe. Or we could put it in stocks and bonds. These are securities, and we could buy shares of stock in individual companies, and those companies, we hope, will pay us dividends and also rise in price. The bonds are also securities, and they're invested typically in companies, but there's a little bit more risk than a money market fund because you're betting on one company, but there's, again, a little bit more return. They're considered more stable than stocks in terms of returns, but they have less risk and therefore less return. And finally, we could not be experts in this investment stuff, and we seek out the help of intermediaries that do investing for us. And there's a whole group of people and institutions that do that. There are funds that are managed by mutual fund managers, and we entrust our money to them and hope that they pick good stock for us and rise in markets. There's also some passive investments we can make these days called Etfs, or exchange traded funds. These are also pooling of money together, but here they're based on operations of certain indices that we may be interested in or have confidence in. The most widely one that we know is the S&P, the Standard & Poor's Index Funds. Everything's abbreviated. We call them SPDRs. And so the S&P ETFs are invested in the broad base of stocks that comprise the Standard & Poor's 500 companies. And therefore, we ride the markets up and down with an ETF. When we put our money with a mutual fund manager, we're betting that they will do better than these passive investments like ETFs. Then we have a lot of other players that facilitate transactions, notably investment bankers. Investment bankers are expert at capital markets, how they operate, all the legalities and the business sides of those important decisions. And they also work very closely with the SEC and the exchanges. So they facilitate companies trying to access the capital markets. And for us as investors, they facilitate our ability to have access to these hopefully great investments. So that's the slide. We have people that have money, people that need money. In the middle are a whole bunch of different markets and institutions that facilitate the movement of money from one side to the other.